Good afternoon, everyone. I hope you managed to have a good lunch, and we are all ready to kickstart the second half of MooFest 2025. You see, the last few years post-COVID have been volatile times in the global stock market. The fact that you are here means a verification of that. You are here to learn more, right? When compared to stocks market like US, most people would think that the Singapore market seems less exciting. I hear this often on Reddit and everywhere else. Some even call it boring. Built largely on value and bank stocks, the Singapore market has a reputation of being defensive. But here's the twist. Year to date, Singapore equities have actually outperformed the global market. In fact, I think recently it hit a new high, which makes us wonder if boring is necessarily a bad thing in investing. Or is it time we reframe how we think about the Singapore market altogether? Singaporeans are known to be kiasu, so if you're kiasu, shouldn't you be already looking at a market that's outbeating everyone else? Now, whether you are an investor in the Singapore stock market or not, this panel is going to be for you. Over the next 40 minutes, I'm joined by experts that will ensure that we head home today with, number one, a better idea on how and why Singapore market deserves a part in your investment portfolio. Number two, actionable tips and strategy that you can adopt. Number three, a deeper understanding of investment instruments such as daily leverage certificates. With me today, we have Jeff Howie, Market Strategies at SGX Group. Gerald Wong, Founder and CEO of Financial Insights Platform, Beansprout. Gladys Lau, Director, Equity Derivatives Sales Asia at UBS Securities. Ng Sing Yao, Investment Director, Equities at Aberdeen Investments. I'm the moderator for today, and to kick off the panel, maybe I'll turn my attention to Jeff. Jeff, in an interview last year, great interview by the way, with Channel News Asia, you mentioned that there's this misconception about the Singapore stock market being boring. You highlighted that the Singapore market is actually one of the most diverse stock markets in the world. Would you care to elaborate more to the audience? And also, what are the sectors or themes that you think the Singapore market are showing the most promise right now?
Thankfully, all those sectors and themes have come together to produce those highly competitive returns you mentioned about before. I think to get the conversation started, let's just look at where we've been over the last 5.5 years. The STI has generated an annualized total return of 9.2%. That's, of course, if you did go lump sum, all in to the STI at the end of 2019 and still held on through 2020 right till now. But if you didn't do that, if you decided to risk mitigate the timing problem of buying everything at the high and holding it down to the low, and instead elect to tranche in and put an equal dollar amount into your STI investment at the end of every month, then those 60 to 70 months of dollar cost averaging would have generated you a compound annual growth rate of 7.2%. So 9.2% lump sum, 7.2% dollar cost averaging, possibly sleeping a little better as well with dollar cost averaging. That's on the back of what's happened in the overall STI. Within the STI, you can look past all the benchmark returns and break it down in terms of revenue. You can see that many of these companies are big Singapore icons that have expanded overseas, so much so that 50% of the revenue associated with all the weighting of the STI is revenue that's generated from outside Singapore, mostly across Asia Pacific. You can break down by sector. Yeah, banks have been super strong. Banks have been what has really led the STI to its all-time high yesterday at 4102.97. They have generated net interest income of at least 8 billion Singapore dollars combined for the last 10 quarters and continue to grow their net interest income on increased trading activity, treasury business as well. Now, that's kind of where I wanted to end banks and the obvious parts of the STI. If you look at the non-obvious parts of it that I think really tell a very compelling story, it's the fact that I mean, you can think of Singapore's relevance globally in the physical trade markets. It might be a little boring there too. You're talking about pharmaceuticals, oil refining, and washing machine sensors, right? Industrial machinery and so forth. Our industrial value chains at the moment are incredibly competitive, and what you're seeing in terms of the banks and this new term that you spoke about with ARFA, value realisation dividend, this is one particular theme that you're going to see transcend from the banks and Singtel right through to the small cap companies into the future. And a lot of those small to mid cap companies are providing industrial services, engineering services that might seem a little boring, but guess what? You've got a massive realignment of global supply chains. Thankfully, Singapore's here on the equator in the middle of Southeast Asia. If we were in the middle of the North Pole, we'd have a lot more issues with supply chain realignments at the moment. You also have a lot happening in AI and automation in the industrial companies that we have here. We've got a slate of examples from Pan United's use of AI to do the record 35-hour, 10,000 cubic feet of green cement fill in what's going to be Singapore's tallest building in the next couple of years. You've got ISO team about to deploy paint drones. You've got CSE Global and SD Engineering that have pivoted to the United States, basically stocks that are following the playbook of what the Trump administration wants. And of course, that really strong construction pipeline here at home, whether it's public or private, that has really awakened our industrial value chain here in Singapore. So my final point, I guess, is that while a lot of the market's been focused on REITs, our sleeping giants have really awoken in terms of incredible increases in trading liquidity, stronger valuations, and that's in these 100 to 120 or so companies that are involved in strong industrial services here in Singapore that are all of a sudden very globally relevant with all those other solid economic fundamentals that Singapore has.
Thank you. Thank you for giving us an overview of the entire Singapore market. So now, if you were to zoom in a little bit more as an individual investors, we hear this often, right? Like, my portfolio should involve some Singapore stocks. But it's always more on the defensive portion. And then for growth, we always look out of Singapore when it comes to the growth portfolio. So maybe for the next question I really want to ask on behalf of the audience is, Singapore stocks are often seen as defensive. How can it also play a part in a very growth-focused portfolio? Maybe I can start with you first, Singya.
Yeah, sure. Well, like Jeff said, actually the returns over the last 3 to 5 years, and if you look at the Singapore stocks, it's not actually been low. It's actually been quite comparable with Asia stocks. Not as good as US, but if you compare the global average, it's actually matching it. And it's actually backing it with a very strong currency. So actually, if you look at, if you're going to use a common currency to compare the returns, actually Singapore is going to be right up there because Singapore dollars have been one of the strongest currency in the world. And even at this point in time, you see US dollar weakening. So, I mean, I'm not a FX expert, so I'm not trying to forecast the direction. But Trump said he wants it weaker, so I have no idea. There is a risk there with US dollar that probably wasn't as stuck in the last 10 years. So Singapore dollars is very strong, backing that returns, as Jeff said. And Singapore stocks overall is lower volatility. So generally, you have sort of quite good returns with a strong currency, and then you have lower volatility. And then, I mean, on the Singapore market as a whole, if you think about whether it can grow, I still think it can. It can still match the growth of Asia as a whole. And why? Mainly because, I mean, Singapore as an economy is not really strong growth. I mean, it's like 2-3% growth. Inflation is like 1-2%. So nominal, what you get, 3 to 5%, is pretty low. But not forgetting that Singapore remains a very strong hub for Southeast Asia. And Southeast Asia as a whole is a very strong growth region in the world. You have countries like Vietnam, Indonesia growing on a nominal basis, including inflation and double digit, right? So, And Singapore as a hub is very important because of the interconnectivity within this region. And so we benefit from actually all this growth. And actually cascade down directly to all the companies, okay, not all, a lot of the companies that are listed in Singapore. So many of them have growth. They have a very strong base in Singapore, but actually their growth are outside Singapore. And so by and large, a lot of companies you see, actually they have growth that are well above the Singapore GDP. I manage Singapore equity portfolio, but I don't really look at Singapore GDP for my company, actually. It doesn't matter because they are getting growth elsewhere. And that's why, because of that hub, and this hub status for Singapore remains very, very strong, a lot of companies can still have very decent growth. Well, I'll stop there first.
Yeah, so for Jared, would you like to add on to Sing Yao's point?
Okay, maybe just a show of hands, how many of you invest in Singapore stocks for dividends? Okay. And how many of you invest in Singapore stocks for growth? Okay, clearly I see more people investing in Singapore stocks for dividends rather than growth. But I think what is interesting to me is that I often get questions why some of the share prices of Singapore stocks have done very well over the past few months. So Singtel as an example, it crossed $4 yesterday. So as an investor of Singtel, you probably realize that Singtel hasn't crossed $4 for many years. So why has Singtel actually done so well? One of the reasons is because it's now a combination of both dividends as well as growth. If you follow what the company has been doing, they are expanding into data centers, and that actually provides the room for the company to grow, which is what we saw in its most recent earnings. So that was something that we covered in one of our podcasts with the company CFO in the Beansprout podcast in the recent episodes. But outside of Singtel, we also have companies such as ST Engineering, where the share price recently crossed $8 per share. And I think for many investors who are familiar with ST Engineering, it never crossed $4 for the longest period of time. But it's one example of a company that has both dividends as well as growth as well, because now we are seeing a growth in defense spending globally, and that is helping ST Engineering to secure a very high order book. So I think this is back to what Jeff mentioned earlier, in that for some of these large cap names, growth is coming back from what they have done to restructure the company and be able to drive earnings growth once again. So I think that's one important proposition that is driving many of these stocks, as well as the STI, to a new all-time high. But I think outside of looking at individual stocks, what's also interesting to me for the Singapore market is that it not only has single stock exposure, we are able to get growth opportunities through other products as well. So what many of you may not actually realize is that now we have got Singapore depository receipts, where you can gain exposure to some of these Chinese names like BYD, Alibaba, in a smaller bite-sized manner compared to if you were buying on the Hong Kong exchange. You've got ETFs that offer you exposure to, say, Hang Seng Tech and the US stock market, and these are growth opportunities that we see in the Singapore market as well. So I believe there are some other products that also offer investors these growth opportunities outside of these traditional names like Singtel, ST Engineering that we are aware of.
How about you, Jeff? When it comes to someone who's seeing Singapore as a defensive market right now, how can they actually, focus it a little bit more into the growth focus portfolio if they are trying to do so?
I think, there's the long-term growth is a really important theme at the moment for the companies. And I think in terms of the macro challenges that we've been facing, that Singapore spirit to really engage the microeconomics, to find growth there, has really played out a lot in our listed companies, from the big ones right through to the small ones. And by the small ones, I mean 300 companies that have less than $100 million of market cap each, and collectively trade only about half of the turnover that Genting trades in one day. what you see in policy world in terms of Singapore Economic Resilience Task Force does extend to these stocks, as Jared was saying. You have a lot of stocks that take their balance sheet seriously, they take their optimization of costs and pivots towards new growth industries really, really importantly. So you can, sometimes when you're looking for growth, you can look for, companies that might take a long time, but might have also suffered from that sub-branding we've had for so long that we're a moribund market. Okay, I have to up the returns. 9.2% wasn't good enough for the last 5 years. Let's try 200% for the year to date. For a stock that's been listed since 2002, the founder, or Kim Piao, has been at the helm for 58 years. They've got a record order book at the moment, which includes the sealed bicycle paths for LTA out on the east. And their turnover this year, trading liquidity, has grown more than tenfold, while their stock price is up 200%. They also, like Gerald said, Singtel broke $4 this week. This stock also broke $1 this week. It broke $1 this week, all-time high, takes its annualized return since the listing in 2002 to, 13% thereabouts. And one more thing, it's had valuation accretion. It started the year with a PE of 3. PE is still single digit, it's 9, but it's still underpinned by strong cash and an ROE of 19%. So the growth's there. It's just we haven't been looking because we've been sub-branded as not relevant enough. But if anyone in the room likes cycling around the east, these companies are very relevant.
Got it. So what we are seeing now when we talk about the current trend is that the STI is actually performing really well, right? So I think the question in everyone's mind is, number one, what's driving this momentum? What's driving this growth, right? And secondly, is this a sustainable trend? Yeah, so with that, maybe for Jared, maybe I can start with you first. I see that you are trying to answer it already.
Okay, I think based on what I shared earlier in that a lot of companies are actually able to improve on their earnings. In that case, the strong performance that we see, the STI, is likely sustainable because it is based on stronger earnings growth that we see for a lot of the large cap companies. The banks are a key component of that, where the 2024 earnings for the Singapore banks are at a record level. And even with the kind of headwinds that we see in the global macro environment at this point in time, we still see the Singapore banks paying a very high dividend. So I think the dividend yield will continue to support the valuation of the Singapore market, especially in an environment where the interest rates are actually coming off. So in the Beansprout community, a lot of the questions are around, with the T-bill yield now coming down to below 2%, what are some of the other income opportunities in the market? So if the Singapore banks are still able to offer a dividend yield of 6% and above, the premium over what you get from the Singapore savings bond versus the T-bill is still something that is very respectable and will form a mainstay of many investors' income portfolios. So from that perspective, I think with the valuation support that we see, the Singapore market's performance is likely to be sustained. And then on top of that, you have got other drivers that come in, including how Singapore is perceived as a safe haven amidst the global uncertainty, as well as what Sing Yao mentioned earlier in terms of the strength of the Singapore dollar.
Understand. So Sing Yao, Gerald believed that this is actually a sustainable trend. Care to jump in with your point of view?
It depends on how you want to benchmark it. Okay, if you want to benchmark an STI, I mean, my own concern is also that the past 3 years, a lot of the returns came from banks. So yes, I agree with Jared. Actually, the valuation for the banks are still not too bad. But to assume that kind of returns over the last 3 years to compound for the next 3 years is just not logical, right? Because that was very strong growth. But they do have the valuation support with the dividend, etc. So now to sustain that growth, I would think you might want the other sectors to help to support that growth. And there are levers. For example, if you look at the interest rate cycle, obviously the past 3 years, that has helped the banks with the interest rates going up. But they are heading down. So if they are heading down, it will help the property sector. I mean, if you are to break down the STI, like 50%, slightly over 50% is the banks, another like 15% or so, those are properties. So it's a very important component. Interest rates going down tends to help the property sectors, including the REITs, and that helps. And then you have the others. A lot of them are also still kind of dividend-paying stocks, whether it's Singtel. The Jardine group of companies are all trying to pay more dividend. So all this will help when the interest rate comes down and you're looking for higher yielding stocks. But also very important is what MAS is trying to do, SGX is trying to do in terms of pushing liquidity into the lower, sort of smaller cap companies. So, I mean, in my mind, when I think about the next 5-10 years of Singapore market, I do think a lot of the growth will come outside of the index. So outside of XTI, outside of STI, because these are the large cap companies. They've already done of the restructuring. They are still decent. But if we can get liquidity, constant liquidity into the smaller caps, actually there are a lot of decent companies with decent growth. They are very undervalued. It's just that when there's no liquidity, there's just not enough capital being pushed down into these small cap companies. So that might help. The other side is, sorry to SGX, but looking beyond things that are listed in SGX. What I mentioned about Singapore as a hub being so important is because if you look at supply chain shifts, etc., you look at Chinese companies going to go international, you look at European companies actually trying to shift supply chains to Southeast Asia and for lower cost manufacturing, they tend to have their headquarters, the international headquarters in Singapore or the Asia headquarters. Now this is important because actually there's a pipeline, potential pipeline in the next few years of a lot of stocks that are actually going to be headquartered in Singapore and want to be listed. I mean, for example, you might use Trip.com as an app. It's a Chinese company, but actually last year in December, they changed their headquarters to Singapore. It's actually a Singapore company now, but listed in the US. Obviously, you already use Shopee, etc. C Limited was always a Singapore company. Grab is a Singapore company. It's just that they are not listed in SGX. So if you're able to venture out, there are a lot more. And then in terms of pipeline, like GDS, one of the biggest data center company, they have a lot of data center coming out in Malaysia. They plan to spin off their international business, and that's listed in Singapore. And the giant one in future, if it ever comes through, I mean, TikTok is Singapore headquarters. If they list here, that's a mega one. So I don't know, but there's a potential pipeline of a lot of Singapore-listed companies a lot of potential pipeline of companies that can, Singapore companies that can be listed here. I just don't know whether they will choose to list on SGX or US or whatsoever. But they are Singapore companies. A lot of good companies are choosing to be headquartered here.
Jeff, do you have anything to add on? Is this trend sustainable?
The trend in terms of what he's talking about.
Yes, the momentum that we are getting from STI right now.
Yes, yeah. Yeah, look, it's up to the investors. But I guess the one thing that concerns me is at this junction, if a lot of retail do get involved into our market, I just hope that legacy of retail being a very smart, strategic part of our market, albeit less retail activity, can continue, because the retail investors, they know what they're doing here, and they don't follow the comment as much as they might overseas and follow the hype. First 2 weeks of April, retail net bought 1.5 billion Singapore dollars into our 3 banks alone. They bought that. What have they been selling? Since mid-April, they've been selling Keppel Corp, which has rallied 30%. They have been taking some profit. So you look at the value and weighted average price for DBS in those first 2 weeks of April, it's about $40. You look at the value weighted average price since then, it's about $44, $45. So about it was 810 million of that 1.5 billion in the first 2 weeks of April of net retail inflow to the banks. 810 million was into DBS, and they've since sold about a fifth to a quarter of that. So the opportunities for rotation are definitely there in retail, but retail, as I said, here in Singapore, do in the past have tended to be buying low, deep value, and what they're using to buy the stocks that are trading at a deep discount to value is the stocks that have been rallying, like Keppel, which has been our second strongest. After Hong Kong Land, which has been very funky, it's up 50% since mid-April. On the 24th of April, it's got its long-term strategic plan into the 2030s, but it also sold a big chunk of its, not a big chunk, $800 million worth of exchange center to the Hong Kong exchange to build a beautiful, basically build this every day for the Hong Kong investors in the exchange center, and also announced a $200 million share buyback plan for the rest of the year. They've already bought back about 115 million US of that $200 million. The average price that they've paid is about $5.30, and the stock's now at around $6.20.
Got it. Okay. Now we are going to shift gears a little bit, Gladys. As investors get better at their craft, they sometimes become more aware of more advanced tools like daily leverage certificates, or DLC in short. This is actually to complement their short-term investment strategy. Based on our conversations, I know that you are an expert in this. So maybe the question is, how can DLC help capture and maximize the trend of the underlying stocks?
Right. So I'm Gladys from UBS Security Asia Limited. Thank you for having me here. So to answer your question, market volatility plays a very crucial role in terms of the dynamic of derivative products, right? So on the 7th of April 2025, driven by the US tariff policies, Hong Kong Hang Seng Index, HSI, actually pummeled over 3,000 points, which is 13% in one day. So making it basically the biggest drop since Asian financial crisis since 1997, right? So since then, the HSI actually gradually regained strength and rebounded to around 24,000 level now. And the volatility presents opportunity that can be captured by Singapore investors using daily leverage certificate, DLC, which is accessible through a regular stock brokerage account. So DLC tracks the performance of the underlying index or stock daily with a fixed leverage factor. So the long and short DLC create opportunities that allow investors to trade both directions of the market. The fixed leverage options include 3 times, 5 times, and 7 times. So in short, I give an example. If the underlying stock goes up by 3%, let's say, a 5 times long DLC, their theoretical value, excluding cost and fee, excluding overnight costs, should go up by 15% because it's 5 times 3, right? But of course, in reality, you still have to factor in the overnight cost, brokerage fee, trading fee, and bid-ask spread, and so forth. So DLC actually stands for daily leverage certificates, right? But it doesn't mean you can only trade it intraday. You can actually hold the DLC until expiry. But please note that DLC had a compounding feature that could bring both positive and negative outcomes. So for example, in trending market with low volatilities, the performance of the DLC for longer than a day may exceed the return of the underlying asset. So, but on the opposite, when we're in a volatile market, the subsequent gain percentage is applied on a lower value. So it would be harder for the DLC to actually recover. So this is actually a key risk for DLC, and thus not really designed to be held for a very long term. So I would take an example maybe from very early on 2022. So actually within a month, Tencent plunged over 38%. And during the same period of time, DLC, a 5-time DLC short, actually went up by 558%, which is way more than the 5 times leverage, right? So on the contrary, if there are consecutive days of negative returns, the performance of a 5 times long DLC, though, will fall less than the overall performance of Tencent. So as mentioned, though, on the contrary, if we are at a volatile market, the potential loss might be greater than the overall performance of the underlying asset.
Got it. So for layman investors like myself, may I know what is the difference between investing in straight into the US market directly as compared to using the DLC? And is there anything that we need to be aware of?
For US index?
Yep.
Yeah, okay. So investing US indexes DLC, of course, helps you gain exposure to the US market in Asian trading hours because, of course, DLC is traded on Singapore exchange during Singapore market hours. So it will also, of course, help you gain a leverage exposure to the daily performance of the underlying US index. So investor can actually trade short DLC to hedge the existing position if you have US stock and enjoy the flexibility to actually trade US stock, US index DLC with a Singapore dollar. So you may ask, during Singapore trading hours, if the US market is closed, then how will the DLC move, right? So actually, during Singapore market hours, the market price of the DLC will be closely linked to the relevant future over the contracts over the US index equity, which are trading during the Singapore trading hours. So our website, www.ubs.com/DLC, actually offers a 15 minutes delay quoting of DJI and NASDAQ 100 E-mini futures.
Got it. So now actually we have some time left, so I'm going to open up the questions to the floor. Actually, the audience have been coming in with very valuable questions which we'll start to answer. I think one of it is particularly interesting and I'm going to potentially mention and also push a little bit more, right? So these questions ask, which stocks are worth looking for the long-term investments within the next year? And please break down your process of identifying these stocks. So I think before we really talk about just a particular stocks alone, I also feel that maybe we should zoom out a little bit and discuss, what are some of the, first, for investors who are trying to include the Singapore stocks into their portfolio, what are the steps to do so? Assuming you now have a pool of stocks that you are holding from every other market. So as an investor who's looking to expose themselves to the Singapore stocks, what's the next step? Maybe Sing Yao, can you help us with this question then?
Okay. So maybe a few thoughts. I can't really, because for compliance reasons, I can't really go down into single stock stuff. I would have loved to chat single stocks, but I can't. But so by and large, how we think about stocks. Okay, restructuring team, to me, remains a very useful one within the Singapore large cap space. I think it's kind of a big Asia team, maybe even global, but you have like Japan companies looking at value up, Korean companies looking at value up. Actually, the Chinese SOEs are trying to go through sort of like a value up reforms as well, trying to pay more dividend, etc. And actually, for many years, you have that in Singapore. So all the Temasek companies actually have all been restructuring, as Gerald already mentioned just now. Jeff mentioned as well, they have been restructuring, improving their ROE, improving returns. So a lot of the large cap in Singapore, that's been the theme for a while. And actually, there are still some companies trying to do that. And that remains interesting because, I mean, they all have mature businesses, they are decent, but very undervalued because maybe there wasn't enough excitement, or maybe they were holding too much cash, etc., etc. But as they improve that, improve the ROE, etc., the stocks become a lot more interesting. And then, well, as mentioned just now, I did mention some of the spaces I like. So I still like some of the smaller cap names in the sense that I'm hopeful that SGX and MES are successful in what they are trying to endeavor. And if they can, we have better liquidity in the lower tier markets, lower cap markets. Then you have some of these hidden gems within the Singapore space that can see an upgrade in valuation. So that's an opportunity. And then certainly the third one is looking for companies that have very good regional growth that might not be listed in Singapore, but for me, as long as, for me, there are Singapore companies nonetheless. My Singapore equity mandate is not just tied to Singapore listed companies, it's as long as a Singapore company. So a lot of these actually companies are actually very exciting, whether it's Sea, Grab, Trip.com, etc. In future, Day One, which is the GDS International's DC data center subsidiary. So all these companies actually possess lots of growth. And for me, they are very interesting as well. Yeah.
How about you, Jared? How would you suggest an investor to include Singapore stocks into their portfolio?
Okay, I think for myself, I always believe in having an understanding of what I'm investing in. So the first step is always to know more about the Singapore market. If you want to do so, there are a lot of resources to be doing so. You have the SGX Gateway newsletter. You can subscribe to Jeff's newsletter. You can go to Beansprout's website, www.growbeansprout.com, where we share with you insights on Singapore stocks, bonds, REITs, and ETFs. Sinyo and Jeff mentioned some of the small and mid-cap names as well. So if you find that you don't have sufficient research on these names, as part of a collaboration with MAS and SGX, we provide research on some of these small and mid-cap names as well. So I think that is really the first step in terms of gaining more knowledge about the Singapore market before we put our money into work. Then I think one of the discussion points that we had earlier is that the STI is at an all-time high. How are we then able to find interesting opportunities in this market? So I think looking beyond the banks, looking beyond a lot of the sectors that you might be familiar with. So since everyone is at MooFest today, here's one special insight for everyone who has joined us today. We know that interest rates are coming down. Many of us usually look at the Singapore REIT sector when interest rates are coming down. At MooFest last year, we were talking about the REITs as an interesting sector. I remember at MooFest 2 years ago, we were talking about the Singapore REITs as well. So don't go into sectors that many others have already talked about, but look at other interesting opportunities that are out there. So for example, Sinyo mentioned that the property sector is 15% of the STI, but outside of the Singapore REITs, you have got also the other property names that are a beneficiary if interest rates were to actually come down. So if you are a homeowner, you'll probably realize that the SORA has come down very significantly. That will likely drive more transaction activity in the Singapore property market, and other names in the Singapore property sector outside of the REITs can potentially benefit as well. So I think that is how I would be looking at the Singapore market, in that while there are sectors already at all-time highs, ST Engineering at $8, Singtel at $4, but you still have got other sectors that are trading below their historical average in terms of their valuations, and that will probably be the starting point for me to look at names that can still present potential upside in today's environment.
Got it. So I think there's a lot more that we can definitely unpack when it comes to the Singapore market, and as long as you are here, you are already getting quite a bit of insights when it comes to that. We are down to the last 5 minutes of this panel, so I'm going to go one round. Assuming you have one takeaway that you want the audience here to take away from this panel, what would it be? One takeaway. Maybe you can start with you first, Jeff.
Yeah, I would say planning, planning, product, and people. So planning by planning, that last question, when you're looking at a company you want to invest in for its growth, what you should see over the next 12 months is more companies giving a lot more granularity in their guidance to what they want to achieve in the next few years. Like your interview with Singtel, when Arthur discussed in quite detail what the plans are for the next 3 years or so, how they're going to come up with that value realization dividend. I think it was it 4.3 cents or 4.7 cents was the value dividend for FY17 out of 17-cent dividend. So you can look for enough guidance and planning from the companies to work out, is this a long-term plan I want to be a part of and own some equity in? The second one is choose your products. A lot of the ETFs, all the ETFs are basically built on indices. And they're a trading strategy in themselves. Obviously, the index should represent the biggest and the best performing stocks of all these relevant sectors or themes that they're covering. So that index per se should be there in 10, 15 years, where some stocks might come and go and so forth. So I think choosing the products right. And also one thing I love about DLCs is if you know a stock really well, you can buy or sell that stock, but also take the opposite position in the actual index that the stock is a part of. So you can hedge out all that macro risk that might actually cause a lot of noise in the stock and just actually find a way to have a more refined, specific, intentional trade. And I guess the third point, of course, is people or partners. This is really important. Having a product or a stock that has a plan, but also having good educational partners. I mean, the chap on my left was highly revered in the institutional world. He's now taken his knowledge and helping a lot of retail investors actually digest and break down much of what happens in our Singapore stock market. And I think the next panelists as well also have that reputation of taking some concepts, breaking it down, and helping you on that journey.
How about you, Jared? One takeaway.
So I think from our discussion, the STI is already at an all-time high. We all need to be smarter in terms of looking for either income or growth opportunities. This means looking beyond what we are very familiar with in terms of Singapore banks, Singapore REITs, and trying to understand what are some of the other opportunities. I shared about the Singapore property sector. We talked about a lot about the small and mid-cap names in the Singapore market. So those are potential opportunities that we can still find potential upside in the Singapore market. Outside of single stocks, we also shared about other products as well. So we have got SDRs, ETFs, DLCs, and we can use all of these different products to build a more resilient portfolio.
Gladys?
Okay, well, I'm just going to quickly give the summary of a DLC feature. So long and short DLC create opportunities by allowing investors to trade both directions of the market and help you to gain leverage exposure to foreign market in Sing dollar. However, please be aware DLC has a compounding feature that might bring both positive and negative outcome, depending on the market and depending on your strategy as well.
Sing Yao.
Okay, Singapore dollars, I just want to emphasize that because I think, in terms of how we absorb information, I think sometimes a lot is neglected around how your returns, when you normalize it into your own currency. If you're making Singapore income, actually you should look at Singapore dollar return, especially if that's your future spending. This is where you're going to retire in future. I mentioned this because I think if you look at, generally if you look at a lot of systems and you tend to just look at share price, it's all local currency. You look at returns of an ETF, it's just, a lot of time they just give you their functional currency. So our systems out there are not generally customized to give you returns in your currency. It's very important that you pay attention to it. Because for example, like Japan, like last year, I mean, the market was up a lot, but you lost 50% of the returns from currency. If you're just looking at the market index, you don't even realize that. I mean, this is just, I just feel that a lot of investors are not naturally equipped with all the system where you get this currency returns customized to what you need. And so paying attention to the currency where you're invested in is very important. And that's where Singapore dollar, the resilience, has actually been very important over the last 10 years. Yeah.
So given that we are celebrating SG60 this year, I think one meaningful way that all of us can mark this event is really to look at our own backyard, right? At the companies and consider how Singapore stocks can really play a role in your portfolio. I think sometimes the best investment strategy is not really to constantly look out, but look at things that you are very familiar with, things that you see every day. So I think with that, to reflect on the 60 years of Singapore growth, maybe it is a good time to also reflect on how we can grow with it as investors, citizens, and also participants in the next chapter of this growth. With that, I would like to end this panel and thank all the panelists here today for sharing their insights and their point of view. Thank you everyone for being here with us.